Does the thought of investing in trailer parks or mobile homes kind of freak you out? If so, you're not alone. Many people looking to invest in real estate, they actually pass up incredible opportunities because they have these misconceptions. But what if I told you that you're leaving some serious dough on the table? And in this video, I'm going to break down the 3 biggest mistakes investors make when they evaluate mobile home parks and how to turn them into passive income opportunities instead. If you're new here, I'm Dr. Jeff Anzalone, a dentist that wants to help you get to the point that work is optional. Check out my free passive income training. Link is below. Let's talk about mistake number 1. You are rejecting deals just because they have park-owned homes. Now, in mobile home parks, there are 2 types of homes. There are tenant-owned homes, and they're exactly what they sound like. The tenant owns the home. This means that the tenant is responsible for all the maintenance, not you, the park owner, but they're responsible for all the maintenance, and they only pay the park owner lot rent. That's the tenant-owned home. Basically, they're just renting the dirt from you. That's it. The park-owned home, on the other hand, are owned by, you guessed it, the park owner. If you own the park, you have a park-owned home, well, the tenant is the one that's essentially the tenant is going to be renting both the home and the land from you. So you, the park owner, is responsible for the maintenance, for maintaining the home. Many investors, they will look at a mobile home park and they're looking through there and they'll completely avoid any type of deal with these park-owned homes because they just assume that these properties, they're just going to require too much work. They don't want the added responsibility of actually maintaining these homes. But here's the truth. Rejecting these types of deals could mean missing out on fantastic opportunities to build passive income. Now, why park-owned homes aren't always bad? Well, and I'm talking about parks with park-owned homes. Well, a lot of times they'll have a much lower purchase price. So these parks, they'll often sell for less because the park owner, they actually know all the extra work that's going to be involved in dealing with park-owned homes unless they do what we do and sell them off. So with a much lower purchase price, that means that you can get the park at a discount. And then also why park-owned homes aren't always bad is because you have a much faster value growth opportunity. When you sell the homes to tenants, like we do, the park's value actually increases, and so does, guess what, your profit. So what should you do instead? Well, instead of just completely rejecting these types of deals, here's 3 strategies that you can do to actually reduce your workload and increase your income. Number 1, like I just mentioned, what we do, simply sell these park-owned homes to the tenants. Sell the homes directly to your tenants. As I mentioned to you earlier, when tenants own their homes, you only have to maintain the land underneath. This means fewer repairs, fewer calls, and more passive income. Second, offer them something called seller financing. What is this? Well, you can actually go in and you can act like a bank by offering the tenants a loan to buy their homes. So what happens is they pay you monthly, every month, based on whatever contract you come up with. They pay you every single month until the home is actually theirs, just like a mortgage. Meanwhile, you're going to continue to collect the lot rent without the headaches of home repairs. Again, this is the strategy that we currently use, my business partner and I, in the 8 mobile home parks that we own. We convert the park-owned homes to tenant-owned homes through something called RTO, rent to own. So the tenants pay a down payment, and then again, they start making these monthly payments that we agree on beforehand. Each payment goes toward both paying off the home and then covering their lot rent. The total amount, it all just basically depends on whatever the home's value is. And the third thing is you can actually help the tenants get financing. So you can actually connect your tenants with lenders out there that actually specialize in financing mobile homes. Who are they? Well, you got companies like 21st Mortgage and Manufactured nationwide who actually offer really low down payments for these types of people, sometimes even 100% financing. So the next time you see a mobile home park with these park-owned homes, don't let fear stop you. Again, these deals can become some of the best investments in your portfolio. Moving on to mistake number 2. You are rejecting deals that have high vacancies. So the first one was you're rejecting the deals because they have park-owned homes. So now you're not looking at any deals just because they have high vacancy. And when you do this, if you're going in and you're automatically just dismissing properties that have a high number of vacant pads, that can be a problem. Now, I can understand that you may be intimidated if you see a listing and you see all these vacancies, and it's intimidating that you may be taking on a park with a large number of empty lots. But again, it also, think about it a different way. It's the way that you look at things. It's your mindset. It can also represent untapped potential. So why or how can high vacancies be an opportunity? Similar to this, you can get a lower purchase price. Parks with many empty pads, they're going to sell for less. Again, this gives you a chance to buy at a discount. And then also you get a higher upside potential. Going in and filling vacant pads can really increase the park's income, which in turn can boost its overall value. So whenever you see a park that has a high amount of vacancies, what can you do instead? Well, you can actually look at where the park's located. Consider the location and the demand. Again, before dismissing a park just due to its high vacancies, look at the local market. If the park is actually located in a growing area, or if they're near major employers, there may be an unmet demand for affordable housing. Perfect example is where I live in North Louisiana. If you Google Meta Data Center North Louisiana, you will see that Meta, the owner of Facebook, is building a multi-billion-dollar data center about 30 miles from where I live in North Louisiana. Think about that. Now, think about if I were to find a park between where I live and that data center and it had a ton of vacancies. Well, guess what? Is this park going to be located in a growing area or near some major employers? Absolutely. So now we know that there's an unmet demand for affordable housing. Something else is you can actually plan for gradual infilling of these vacant lots. Don't expect that you're going to go in and fill all these vacant pads immediately. It's not going to happen. Instead, you should consider setting realistic goals for adding just a few new tenants over time. You can actually partner with a local mobile home dealer in your area, or maybe a local investor, to bring in homes that actually meet the local demand. I didn't actually realize until I started buying mobile home parks that there's actually people out there, people in your area that are investors who want the ability to rent out mobile homes to people, but they don't want the responsibility of owning the whole park. Now, if you can find these investors, as we have again here in our area in Louisiana, then this can provide an additional source of tenants to fill your vacant lots. Then the best part is somebody else is handling the entire process for you. And another thing that you can do, you can actually leverage creative financing to fill the vacancies. You can actually offer incentives to prospective tenants, such as maybe a lower lot rent for the first few months, or seller financing for some of the homes. What this is going to do, this is going to attract tenants to help fill those empty pads a lot quicker. Again, by seeing high vacancies not as a deterrent, but as an opportunity, you can actually turn an underperforming park into a valuable asset that's going to start generating strong returns. And last but not least, mistake number 3, not having an exit strategy. You've probably heard the phrase, start with the end in mind, right? One of the most overlooked aspects of mobile home park investing is actually failing to plan how you're going to exit the investment in the first place. Without a clear exit strategy, it's really difficult to know when or how to take your profits, or maybe you should just move on to another opportunity. So why is an exit strategy, why does it matter? Maximizing your return. So a clear exit plan is going to allow you to determine the exact time or the right time to sell or refinance. It's going to ensure that you capture the highest possible return on your investment. Number 2, adapting to challenges. So if a property isn't bank financeable due to maybe issues like park-owned homes, maybe there's some structural problems with the park, or other operational challenges, an exit strategy is actually going to help you address those problems and create a pathway to long-term financing. And number 3 is securing a long-term plan. So knowing how you're going to transition out, whether by selling, refinancing, or repositioning the property, is going to align your short-term decisions with your long-term financial goals. Something else that you can do, you can actually leverage some government programs. So once you've invested in a park and you've got it stabilized, you should consider, and depending on what your interest rate is, if it's high, like we have several of our parks right now, actually 4 of them, that high interest rate, and we're in the process of doing this, you could consider refinancing into long-term financing through specialized mobile home park loan programs offered by, these are government programs, Fannie Mae or Freddie Mac. These 2 programs are different. So Fannie Mae loans, they generally require the property to have at least 50 pads, a minimum occupancy rate of 85%, and no more than 25% of the homes that are owned by the park or park-owned homes. The LTV, the loan-to-value ratios, can reach up to 80%, and fixed interest rates are available for terms up to 30 years. Now, Freddie Mac loans, on the other hand, those are more accessible for smaller parks or smaller properties. All you have to have is just 5 pads. And these loans, they also have a maximum of 25% rented homes or the park-owned homes, while homes must actually meet HUD safety standards. Borrowers need at least 2 years of experience owning mobile home parks, and they must meet certain entity type requirements. The Freddie Mac loan offer LTVs of up to 75%, and again, fixed rate terms up to 30 years. Both of these programs are expected to actually tighten their underwriting standards, but as of now, they remain strong options for stable, professionally managed communities. So again, if you have a park or you have a property, high interest rates, it's coming due, these are 2 really good programs to look into. And let me give you a practical example to sort of tie all this together, all right? Let's say that you acquire a park and it's got some operational challenges, such as maybe it's got some high vacancies or park-owned homes, and you actually use seller financing to take ownership. Now, over the next several years, you start to improve the park's NOI, the net operating income. You start to increase the occupancy rate, and then you resolve these issues, the physical issues that they're having. Now, once the park meets the standards set by either Freddie Mac or Fannie Mae, you decide to refinance into a long-term loan, enabling you to actually pull out your initial down payment and even some profit. Now, this approach allows you to actually recoup your investment. You can take that money and you can turn around and reinvest it in other properties, or you can pay down the debt, all while still maintaining the ownership of a stable cash flowing asset. So for me personally, my strategy is to purchase these parks and to hold them forever. Why? I want the cash flow. That's how you get to the point that work is optional. You buy assets that cash flow, they don't involve your time to pay for your liabilities. Now, currently, it makes sense to consider a cash out refi on several of our parks because they were purchased again with really, really high interest rates shortly after COVID. But now, because we have improved the profitability of these parks, we can likely recover all of our initial down payment and then some to again reinvest in other properties. This is one of the many reasons why I personally just love real estate investing and why it's something that you can't achieve it in the stock market. So by understanding and addressing these 3 key mistakes, you can actually unlock true potential of mobile home park investing. Instead of, again, just turning away from challenges, approach them instead as opportunities to add value, to increase your income, and create a more stable investment. With the right strategies and a clear long-term plan, mobile home parks can be a very powerful asset in your portfolio, delivering both my favorite, cash flow, and future growth. Now, I have a special treat for you. If you want to join me and see sort of a sneak peek behind the scenes at one of my mobile home parks, and then how I'm actually using one of the best tax advantages out there, depreciation, to save thousands and thousands of dollars, then do yourself a favor, check out this video.